So in the publicly traded space, you're looking at, well, I actually looked at the 10-year average annual return on the Bloomberg US Aggregate Bond Index. That's 1.6%. Okay. So if you're want to compare that to private credit, if you look at over the same amount of time over the last 10 years, the private credit returns annualized are 8.8%.
Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Sean Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach and speaker. And I'm here to help every teacher, whether you are a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck to have a richer wallet, classroom, and life. The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional. I'm super excited to have Dara Albright on the show today. Dara is the director and board member of Worthy Financial and is a licensed investment advisor. So we're going to be talking all about bonds today. And because of those two positions, Dara knows a lot about bonds, and then also some kind of alternatives that we can look at when we're talking about bonds, because you know me, bonds aren't my favorite thing. So we're gonna dive into that whole world. Dara, welcome to the show.
Thank you so much. And I'm going to make bonds your next favorite thing.
Okay, bonds are my next favorite thing. I can't wait. So we're talking about bonds and income investing today. So let's just start with some regular bonds, just define these for some people so we know what it is. What is a bond? How does it generate income? Why would someone invest in a bond?
Sure. So everyone knows stock investing, right? You invest in a stock, you get an ownership stake in that company. Bonds are a little different type of investing. You're essentially investing in the entity. You're really lending the entity money. So you're lending the entity money, and in exchange for the money, you're getting interest payments. That could be, paid quarterly, could be paid biannually. It depends on the nature of the investment. So typically we call them fixed income investments because you're basically getting a fixed return on your investment, and then for a certain period of time, and then when that due date is due or that time period ends, you basically get your principal back. And that's the difference between a bond investment and an equity investment.
Yeah, it's great explanation. So it's just paying interest versus growing in value is really what's happening there for
Exactly.
sure. So for some context, why am I talking to Dara? Well, I connected with her company, Worthy Bonds, at FinCon. For those of you who have been listening, I've talked to a lot of people from FinCon, and very few companies from FinCon have come on the podcast because not all of them very, very impressive. But I was quite impressed with Worthy and the products that they offer. So I want to talk about those a little bit. So can we just define some terms? What kind of bonds are we talking about with Worthy?
Sure. So I also want to go into a little bit the difference between some of the traditional bonds that are out there that people are familiar with. I basically gave a broad definition of a bond. When people look at invest in bond investing or investing into a bond, they are typically looking at a publicly traded entity. So it could be a bond investment, like, you're investing in Apple Corporation, a publicly traded entity. These are who issue publicly traded bonds, or a treasury bond, or a municipal bond, which, in that case, you're investing in the municipality or a project within your local community. Maybe it's to build a new highway, and then your bond is actually backed by the tolls that are being paid, and that's how they generate that income to pay you. So that's like typical publicly traded bond investing. We call these, traditional bonds. Worthy is in the private credit space, which is very different than the publicly traded space. And we'll dive into it, but that's where really the returns are now. So in the publicly traded space, you're looking at, well, I actually looked at the 10-year average annual return on the Bloomberg US Aggregate Bond Index, which is a key benchmark that tracks all publicly traded bonds. So that would include treasuries, that would include corporate bonds and mortgage-backed securities. That's 1.6%. Okay. So if you're looking, want to compare that to private credit, if you look at over the same amount of time over the last 10 years, the private credit returns annualized are 8.8%. So there's a very, very significant difference between those publicly traded bonds and entities that you could lend money to the private ones. So and just to give you background and a little kind of frame of reference, over the last 10 years, institutional investors and sophisticated investors have been pouring money into private credit because that's where the returns are. So, it went from, I think it was a $200 billion market in 2015 to now over 2 trillion. So it really has grown significantly in the private credit space. Worthy plays in this arena in private credit. So what Worthy does that makes it a little different, Worthy issues a number of bonds. But what Worthy does and makes it unique is that Worthy's bonds are not backed by the revenue of the corporation of Worthy. What Worthy does is Worthy is a investor in primarily real estate, where the returns are, quite substantial. They get generous, I should say, nice, generous returns that many in the institutional world or, high net worth individuals are receiving. And what Worthy does is they invest in these lucrative deals that are backed by actual real estate, backed by supported by the actual property. And what Worthy does is unique, is Worthy uses a qualification process called Reg A Plus, which is a way of registering these bonds with the Securities and Exchange Commission, so they're qualified to be sold to small investors. And then what Worthy does is it invests into these lucrative real estate opportunities backed by these real estate properties. And then what Worthy does is go through the process of registering them so that they could, quote unquote, fractionalize, if you will, basically make their investment. Essentially what they do is they'll split the investment with their investors. So they give a small retail investor an opportunity to participate in these lucrative kind of investments for as little as $10, a minimum investment. So that's basically what Worthy does. And unlike, if you're investing in a publicly traded bond, you're not, that would be, you're basically you're investing in the credit worthiness of that, of that issuer. With Worthy, it's a little bit different because it's basically backed by an actual real world asset, in this case, real estate.
So we're talking about that Worthy's products, but we're also talking more generally about, bonds that are private bonds versus public bonds. So the bonds that I was always, aware of, the ones that people talk about using bonds to, shore up your portfolio or whatever, has always been the, public bonds.
Right.
The under 2% that you were talking about bonds is like, why would I invest in something that's not going to keep up with inflation? That kind of thing, right? So that's something that has always concerned me when I was looking at bonds. Like, this seems like not a great place to keep my money. I mean, like, there are some high yield savings accounts right now that are earning more than that average. I mean, granted, that's a 10-year average, but still, the point is, like, that's quite a substantial difference between that, 1.8% versus the 7%. Usually when you have the big of a gap between something like a public bond and these private bonds we're talking about, that higher return comes with a higher risk. Can you talk about maybe the difference in risk between like generally with these private bonds versus public bonds, and
Sure,
leaving worthy
sure.
out of it right now?
So the main reason why the returns are so much more attractive in private credit as opposed to more traditional bonds is that, and the reason why you're getting that premium, it's basically it's the premium you're getting is because they're not liquid like publicly traded bonds. You could buy a bond and then you could sell it. When there's an open market for, they're very liquid in most cases. It's very different with private credit. You're really looking for a longer term hold typically. That now I'm taking Worthy out of that discussion because Worthy actually has a liquid product where they would redeem your bond, but that's typically why, and that's where the risk is. It's really more of a liquidity risk.
Yeah, awesome. Okay, that makes a lot more sense. Just wanted to make sure that we were clarifying like what is the risk, because there's always like whenever you see a higher number, there's going to be more of a risk involved with that almost every single time. So, illiquidity, that's a good thing to know, because if you're like, man, I'm going to put my money into, a random private credit thing because I want to have money for retirement. Well, if you can't get it for another 10 years and you're retiring this year, might not be the best place to put that money, right? So, while the reason why people usually put money in a public bond is to avoid the volatility of the stock market when you're going into retirement. So those are two separate things that we're looking at right now when we're talking about just general private credit with the illiquidity versus the public bonds, which are quite liquid. So you need to make sure you understand the risk behind it, right? It could you lose your money, right? How likely is that? The return, how balance that with how much you're getting back from it, and then liquidity. Can you get it? Do you need it right now? Do you not need it right now? That kind of thing. So those are the things that we're balancing when we're looking at these two different types of bonds. So
Yeah.
speaking of retirement, I want to hear your thoughts on this question, because this is my reason why I'm not a big fan of bonds, because teachers have a pension, which is a very dependable paycheck that comes in, just every single month for the rest of your life, right? So usually they are livable. They're not high, but they're usually livable, right? If you cut back, you could live off of that pension. While having money in 60-40 bond and the stock bond portfolio, you do that because if there's that swing and everything drops, you have those bonds to kind of balance out that volatile market while you're in retirement. Having that annuity or that pension, whatever you want to call it, as that safety net seems to serve the function of those bonds in that portfolio. So would you say that bonds are still a good choice for teachers to invest in when we have that pension? If so, why? If not, why not?
Okay, so I want to start that with a disclaimer because none of this is to be construed as investment advice. But and everyone has a different, everyone is different. Every investor is different. Every teacher is different. Everyone has a different risk profile, and every teacher is a different age. So it used to be when I was first starting off, in the financial industry, it used to be they used to tell us that it should go by your age. So it used to say that it should be whatever your age is, that should be your bond investment. I'm sorry, whatever your age is, yes, that should be your bond investment or your fixed income side of your portfolio. And whatever, and then the rest is your equity side or your growth portion of the portfolio. So 25-year-old teacher that's just starting out, it's not recommended that you put the majority of your money into a fixed income portfolio. You're better off because you have all that time and all those years ahead of you to be in growth. So they used to say for that, you would say a 25-year-old, typically it would be, and this is, not the 60-40. So that for the 25-year-old to say 25% bonds, 75% equities. I think that's all changing now too because of the rise of private credit and private equity and other alternative assets that are now being available to regular retail investors, which retail investors didn't have that opportunity to before. So I would look at, first of all, your age. Now, that would be the first thing I would look at. The second thing I would look at would be what is your, risk profile. Now, since we're talking retirement, typically this is a long-term investment. So you really don't have as much liquidity risk because you don't need the liquidity, right? Especially for a 25-year-old, if you're investing in your, 403B, you've got years and years and years. So if you're putting money in, you could ride those waves when the stock market is, tumbling, the volatility, you have plenty of time for that. Now, as far as would I recommend a traditional publicly traded bond investment in a retirement portfolio? Probably not. I mean, I agree with you. I mean, I'm not really a big fan. I mean, not with these yields so low. To me, you could do so much better. And, when we talk about risk, when you're in making an investment or you're lending money, or let's say you're investing into a publicly traded bond, it's also backed by that particular entity. So when you're making an investment into, let's say, a US Treasury, which, that's kind of deemed as the highest rated that you could possibly get. It's backed by the full faith and credit of the US government. So you're counting on the US government having the money to keep on paying those interest rates. We have a lot of debt right now in the country. So, so that's what if you're investing in a publicly traded bond that's, issued by a publicly traded corporation, your risk is the credit worthiness of just that one issuer. So I would argue when you look at some of, if, like, for example, what Worthy is doing, where Worthy is investing into a diversified portfolio of real estate assets, I would argue you're probably getting, you don't have, obviously there's the risk with respect to liquidity, but if you're looking at the long-term hold, to me, it's a no-brainer because you're also getting a diversified, portfolio.
Okay, so let's start moving into this space. So, like, if we're talking about public, traded bonds, both of us are kind of like, nah, okay. Once again, you do your own research, talk to your own, advisor, all that stuff. But we're both looking at these publicly traded ones. They're low yield. Maybe the full faith credit in the United States isn't as great as it used to be. Maybe, hopefully it stays good, but you never know. What can we do instead? So when we're in retirement, we don't want to deal with the volatility, right? The idea of trying to withdraw from a portfolio that just dropped 10% to support your life is pretty terrifying in retirement. So we need to figure out what other high yield, low volatility alternative investments there are. So what other options are there for somebody who maybe doesn't want to, just put bonds in there just to, like, stabilize their stock portfolio, but they want something else that can, maybe be bringing in some income. So that way they can kind of step back from that stock portfolio if there is a major swing.
So if what would mitigate some of the risk of investing into a bond directly would be a bond fund. But still, I think you have a lot of the same issues, even a publicly traded bond fund, there's still a lot of the same issues. Yes, you have a little bit more diversity because you have, more companies that are within that fund that could offset one of those companies goes under and can't pay. There are a lot of other companies in there that could, that are still paying. So that all, giving that issuer diversity is good. However, I would also argue that, and here's really the problem with any traditional asset that's publicly traded. There are right now, now this is actually really, really interesting, and I don't think a lot of people know this. So there are right now about 4,300 publicly traded companies that are out there in the US. Okay. Now that's down from a little over 8,000 in the 1990s. So already our diversification is going lower, lower, lower. We're having less and less opportunity to diversify, okay? With traditional assets. Now, out of those 4,300, it gets even worse because out of those 4,300, there's really only 250 of those stocks that are really active. Now, every single investable asset in the traditional asset universe is all a byproduct of those 4,300 publicly traded companies, of which really only around 250 are really active. Okay, so already we are very limited when it comes to diversification in the traditional asset landscape. Now, it even gets worse than that because if you're going into a fund and typical actively managed fund, maybe they'll only, manage maybe about 150 publicly traded assets. Now it gets even worse when you're talking about passively managed, which is basically just an index fund. Because right now, the index funds that are out there are heavily weighted in just 7 stocks. They call them the Magnificent Seven. And, that's like Microsoft, Google, Apple, the names that most people, would recognize. Right now, the index is 35% of the index is in only 10 stocks in the S&P 500. And out of that, there are 7 stocks, the Magnificent Seven, that make up I think 50% of NASDAQ. So you're investing into S&P 500 and NASDAQ, no one's getting really any diversification. Now let me bring that back to bonds for a second. Out of the bonds that are out there, there are really only about 50 actively traded bond issuers. And this is just in the corporate world. I'm not talking about government. So there's already a lack of diversification in the publicly traded corporate bond world that's out there. So even if you're going into a bond fund, I think you are still really limited, with respect to diversification. And like I said, what's really unique about the alternative space and the alternative credit is that you are able to have more diversification and more of these assets backed by real world assets like real estate. Now, you asked about other kinds of alternative, maybe fixed income instruments. We're also starting to see the rise of staking in the crypto world. I'm not going to go into that because that's a whole separate podcast, but there are a lot more opportunities in the fixed income space that are emerging to really provide much better yields to investors. Now, what's interesting is that, for teachers have a 403B, which is like their 401k, right? For it's like a 401k for teachers. But your 403B, you're very limited in the investments that you could have so you basically, they'll come to you and say, hey, you could pick from a certain list and it's typically, they'll give you like a minimum of 5 different funds that you could choose from. So maybe it's a, stock fund, a bond fund, a hybrid of both, a balanced fund. And that's it. I mean, so you're really not getting diversification the diversification that you think. Now, what could teachers do? Well, or anyone, and even in the corporate world with a 401k. So there are a lot of solutions out there where you could really take more control of your retirement, your retirement portfolio and your retirement assets. So there are things that you could do like rollovers into self-directed IRAs. There are now emerging ways that you could have an advisor actually, help you manage and be more self-directed, take more control of those assets as well. So you could access a lot of these alternative products, because the whole world is going towards the alternative world, because we simply do not have the ample diversification in the traditional asset world to support all of the retirement portfolios that are out there. We have, you have over $20 trillion in retirement funds in the US alone, all chasing those same 250 publicly traded stocks and those same 50 bonds. That's not, that's not proper diversification.
Right. So we can diversify by not saying, completely jump out of all stocks, but, there are other
Yeah.
places to place your money to be able to grow it and maybe to have some dependable income. Well, I did have a question. You brought up self-directed IRAs, and I'm just curious from my own curiosity. With the self-directed IRA, are you able to invest in private bonds like with Worthy, or is that something that's not possible at this time?
So yeah, self-directed IRAs give you the opportunity to invest in all various kinds of alternative asset products. You basically you're very you have so much more of a pool to choose from. The thing, you could invest directly in real estate as long as it's not an asset that it can't be your home that you live in. You could invest in art as long as it's not art that you're using and hanging on your wall. So you could invest in wine. I mean, there are a lot of alternative, asset classes that are now available that you could use in a self-directed IRA. You could invest in Bitcoin directly through, a self-directed IRA. So gold. I mean, it really, more and more people are really understanding the benefits of actually having even just a small portion of their retirement portfolio allocated into the alternative universe through a self-directed IRA.
So just specifically, are you able to invest in Worthy through a self-directed IRA?
So yeah, yes, you can invest in Worthy through a self-directed IRA. You can invest in any almost any. We're working right now with a couple of different custodians that are putting that, interested in putting that on their platform to give that opportunity to investors to use their retirement dollars. So yeah, that's definitely something we could, talk about and help with if any of your listeners are looking for that.
Right. Awesome. So, whether it's, Worthy bonds or wine or whatever, if that's something you're interested in there, I love this idea because, if you are putting money into this tax shelter, it's a very, powerful tool. But, for example, like a bond paying you interest, that's going to generally have some pretty strong tax implications. But if you can let it grow without those tax implications in a self-directed IRA, it can be a lot more powerful, I think, at the end. That's just my thought on that. So definitely a very interesting thing to look into as a place to put your money inside one of those tax shelters, because that interest is, one of the most heavily taxed form of investments. So we definitely need to consider that when you're making your decisions.
Yeah, that's great advice.
Okay, so I did want to get into Worthy, and I'm going to have you give me all the good stuff about it, but I do want to ask a question about this. So like if I'm investing in Worthy or any of these other private bonds, the thing that concerns me most about it is I'm putting all my money with one company, right? Now I realize that, you're investing in a lot of different places, but let's say you have a CEO who does something terrible, or, something happens and the market drops out from under you and you go bankrupt. What happens to my money, right? So that's the concern for me. So like, how does a private bond company protect their investors from that kind of risk?
Right. Well, I mean, so first of all, I would say never put all your eggs in one basket anyway. Whether it's you're looking at, investing in the traditional markets or in the alternative markets. So I'd say if you're investing, let's say $10,000, I would spread it across different asset classes, different issuers, different companies. I would never put all of it into just one entity. But what I would say for those who are looking, well, that's the best. That's really the only protection that you have, really. And that's public or private, alternative, traditional. I mean, when it really comes down to it, your best protection will always be diversification. So that's why the bigger the more broad the opportunity, the investable landscape is, the better off you are to really protect your assets.
All right. So it is possible that you're going to lose your money. So there is that risk as well. But that's why you don't just put it all in one spot. Is that pretty
Exactly.
okay?
Exactly.
Awesome.
And
Um,
and that's and I would also add, let's like a company like Worthy, where some of their bonds you could go in for as little as $10. So, you're able to, when you're looking at the alternative asset world, there are a lot of very, very small minimums like that. So you could really diversify across a lot more, a lot more assets and a lot more opportunities, whereas you really don't have that luxury or option in the publicly traded universe.
okay, awesome. Well, we've been mentioning Worthy a lot. I'd love for you to just take a moment to explain, why it's great. You've talked about a number of things, but like just toot your own horn a bit, because like I said, I thought Worthy was a fantastic bond product that had great returns, relatively low risk, and I enjoyed hearing about it. So let's hear a little bit about it for those who might be interested in using this as a portion of their portfolio.
Sure. So here's the things I love most about Worthy. So, well, first of all, there's Worthy Financial. Worthy Financial has a product that it's real estate backed. They invest in various real estate type of investments. For the investor that's investing in the Worthy Financial, or they're called Worthy Property Bonds. There are different funds: Worthy Property Bonds 1, Worthy Property Bonds 2. And in the Worthy Property Bond world, you're essentially you could get a Worthy Property Bond for as little as $10. It yields 7% annually. And if you need the liquidity, the bond is redeemed without fees. So it's basically, to me, it's a no-brainer. Now, what I also love about it is that it's also, you could tie it to their Roundup savings app. It's a digital savings app that essentially collects your roundups as you go shopping. So you attach your credit card, you go to Publix, go food shopping, and you buy $99.50 worth of groceries. You pay 100, that 50 cents of the difference goes into your Worthy account. Every time you hit $10, it automatically buys another Worthy bond for you into your account. And, by the end of the year, you've got, typically for the typical, the typical Roundup user, you're basically saving a couple of $100 each year just from doing that. That's earning 7%. So I love that feature and I love that ability. So to me, that's, it's a great product. It's a great way, especially I think for teachers, to have not an alternative to your 403(b), obviously, but it's a supplement. So it's a great way to just accumulate money, and it's not just for retirement. So if you need it, you could take it out, and it's all done with, after tax dollars. So there's no, you're not getting the tax deferral or, those advantages, but you're also not having to pay any taxes either well, I shouldn't say that, but it's not in a tax, not in a typical what you would look at as a retirement account that's accumulating tax, tax deferred.
Once you've paid
And
the taxes on it, you can then pull the money out anytime. Absolutely tax free,
exactly,
right?
but
It's like,
but I would imagine that you're subject to, you would be subject to income tax on the 7% that you were getting over
but
the,
that's
so,
happening as it goes, right? So it's like
right,
you
right.
pull it out, you're not paying tax once you pull it out because you've already paid it along the way, which is, I feel like people are so into like, retirement accounts that we sometimes forget that you might need money that you can pull out that has already been taxed. Let's say you uh, break your leg and you're bedridden for 6 months, and you get some disability for a few months, but then you have a few months of a gap. Your retirement accounts aren't going to come to save you usually in that situation, because there's so many different like things that you have to do, hoops to jump through to be able to pull that money out without paying a 10% penalty.
Yeah,
Having some money on the side that is just earning interest, like I think about this, if you have like an emergency fund and you just like plop that into these bonds, right? It's going to be earning a really high interest, but then you have an emergency, put it on a credit card, wait the day or so for Worthy to process that moving back into your bank, pay off the credit card. It's an emergency fund that's earning a really high yield. So I think having those already taxed dollars that are just there that are earning a high yield is a really powerful thing to have on hand.
right. And now, but you would have to, depending on how much you've invested, like there will be like there will be tax consequences to the earnings, so there always are.
Yes,
Um,
like every year you're going to pay taxes on, say you earned
that
$100 in interest, you're going to pay
exactly, exactly.
taxes on that. But I'm saying like when you pull that money out, there's no like penalty like you're going to
No
get in a
penalty.
retirement account. You're not going to have like I pulled out $1,000, even though I only contributed, or I only had interest on $100. I'm not going to pay taxes on that 1,000, just on the 100 in interest, because that was already just in the account. So like there's just
Exactly.
having that money that's flexible to use and earning a good interest rate for you. So I just feel like that's going to be a really great a really great place to put your money when you want really liquid funds, because those retirement accounts are just not as accessible. That's the point.
100%. And it's a great little, you're right. It's a great little saving supplement. I mean, and what the best part about it is that it's not like you're actually writing a check to the company to invest in, and say, okay, here's $500, put this in my account, and and I want those bonds, and and your return, the interest. It's even better than that, because you don't even realize that you're saving. We call it couch cushion money, because it's basically rounding up your spare change, that's being invested in these 7% annual annual yielding bonds. So it's like, you look at the end of the year and you've got, let's say, $300-400 saved, that's in there earning 7%. You didn't even realize it, because it wasn't like you wrote the check for the $400. It was basically, all your, annual basic consumption. So it's a great way, we call found money. And it's just, it's a great way to supplement. And you're right, it could be used for retirement, it could be used for saving for, it could be anything, saving for a vacation, saving for, college education. I mean, it could be really for anything. So that's what we love about that. Worthy also has, for people that if you really don't need the liquidity so fast, Worthy just launched Worthy Wealth is a new entity that was provided to produce even higher yielding products, and even some financial literacy for investors out there. And they have another product, Worthy Wealth, called Worthy Wealth Senior Living Bonds. Now, what's really great about the senior living bond is that it's targeted an up to 15% annual return. Now, the difference is you're holding them, so you don't want to liquidate these. This is, you're holding them. That's a little bit higher minimum. It's $100 minimum investment. It's a target term for 5 years. but there's a payment schedule. So the first year you'll be getting quarterly payments with a 5% annual yield. And then that's for 1, 2, 3, then it's 7% thereafter. Now, what's great about it is that your money in the senior these particular bonds, senior living bonds, your money is actually going to revitalize senior centers, senior living places, around the country. And so you're making, you're really, they go in, they improve the lives of all these seniors that are there. So you have that impact element to it. And then when when they're selling somebody, after they go and they restore these properties and they improve them, they would sell them at some point, and there's like a little bit of an equity upside that the investor gets in that as well. So that's where you're getting that up to 15% annualized return. So if you want a product that you have 5 years to just put away, not look at, and doing something good, helping some, grandma and grandpa out, that's a great product too.
Yeah, and this is the last thing I want to talk about before we wrap up. You mentioned impact, right? And this is the other thing that impressed me about Worthy, was that the focus was impact investing. So can you just talk about what impact investing is and why that matters for a community?
Yeah. So, I mean, a lot of times people also think that when you say impact investing, that, you're also sacrificing the returns. I mean, in the example I just gave, you can see it's not true. You're actually even getting higher returns, but you're also doing something, that could benefit society with your money. So I think that impact investing is a great way for people who want to do something meaningful, in some way benefiting society or some community or what have you, but also at the same way generating returns from that. And and like I said in the example I just gave, there's a way that you could do both. You could actually do something meaningful with your money by also getting a return out of that.
Yeah, so these bonds are for the real estate bonds, and senior living bonds. They're building things, they're creating things, and not just frankly going to Apple. Like what's Apple doing with your stock money, right? They're just making more gadgets, right? Like I love the tangible impact on the world, the building things, building communities, building senior living, that's helping the seniors live a better life. I really like that. I feel like, for me, uh, something that is going to generate income, but also generate a positive outcome for the world. That's powerful because we have our balance sheet, I guess. You have assets and liabilities. Well, assets don't just have to be money, right? They can be just positive things that move the world forward in a good way. And the fact that you can have the positive money asset and the positive world impact asset, I think that those are both really powerful, as opposed to, investing your money in, I don't know, some company that's dumping, waste into the river. You're getting money from it, but that liability on the other side of the waste in the river, not so great. So I really like that aspect of what Worthy's doing, especially with the senior living thing.
Yeah, I could not have said that better myself. That was perfectly stated.
Thank you. Well, Dara, this has been a great conversation. I'm glad that we've understood bonds, the different kinds of bonds, alternative investments. There's just been a lot we've talked about. But just boiling it down, got two more questions for you. What is your number one tip for teachers to have a richer wallet, classroom, and life?
I love this question. I think it's a great question. And my answer is going to be something very familiar to teachers. And my answer is education. And I just think it all comes down to improving your financial literacy. I think that's a big problem that we've all, been really lacking with that, even in our schools. Like now, schools are starting in high schools, they're starting to put financial literacy programs and implement that into the curriculum. I can't even say how important it is to just really, go out and learn as much as you can. And especially now, because there is this whole unfurling world of alternative assets that are out there that, and let me tell you, not even the investment advisors are being educated on, or trained on. So there's really a whole universe of assets out there that if, you're just out there and you're really doing your own research and you're learning, and at Worthy, we're actually going to be putting some, financial literacy programs together to really kind of help people navigate this new world. But I mean, I just think that education is the best thing you could do. It's the best thing, for anyone to do in life to getting, ahead in life, but also, with your wallet.
I love it. Love that response. Fantastic response. Okay. So last question. So I'm going to have a link to Worthy for you to be able to get all that at teachermoneyshow.com/podcast. You can find the show notes there, or if you go to your podcast description, you can find the link directly to the show notes page for this show and get a link to Worthy and get all those products. But Dara, if someone has a question about Worthy, they want to know more, are they able to reach out to you, or is there someone that they can reach out to ask a question of? And
Yeah,
how
sure.
can they contact that?
Yeah, sure. But feel free to reach out to me. I'm on LinkedIn. You could find me on, I think it's just if you go to LinkedIn and do Dara Albright, I think that's the actual, my handle is actually from LinkedIn on Dara Albright. Open to, connecting with anyone, always happy to help. So, anyone has thoughts they want to share, if they, want to, have, if they're interested in learning more, yeah, feel free to reach out anytime.
Perfect. Thank you so much, Dara. This is a great conversation. Thank you for coming on the show.
Oh, thank you so much for having me.
Wow, that was a great conversation. Dara, thank you so much for coming on the show. That was a ton of fun. This show is brought to you by Worthy. Now, they are not paying me for them to come on the show. I invited them, but I do have a link for you that if you would like to learn more, you can go to the show notes at teachermoneyshow.com/podcast, or you can look in your podcast description player to get the link there. And you can learn more and participate in these bonds, which are frankly way better bonds than these publicly traded bonds that we are talking about. Okay, now on to the Cliff Notes. Cliff Note number 1, higher returns can be found in the private versus the public market. So if you are trying to have something that's kind of stable, but you want to have more money coming in than that 1.8% we were talking about, definitely look into private. But there is a risk. So number 2 is the illiquidity risk. If you're investing into these public bonds, there's probably going to be a liquidity issue if you need the money right now. So make sure you are aware of not only the risk and return and the volatility, but also the liquidity of those bonds. Number 3, public bonds ain't as good as they once was, right? They're just not doing as well. They used to be like the standard, right? Treasury bonds had high yields and there's all sorts of things, but they're just pretty low. So if you're looking for a higher return, maybe look in a different direction. All right, number 4, I thought this was fascinating. Diversification has been cut in half over the last 30 years. Can you believe that? 8,000 some odd companies to 4,300. That's crazy. And only 250 are really doing anything. So I'm not saying that you're not diversified in the total market or the S&P 500. In fact, I think that you are actually quite well diversified. I would disagree with a little bit with Dara on that, just because I believe in the economy of the United States, and as good companies rise and bad companies fall off, it's going to work out. But I still like the point that she's making of it's not as diverse as you might think. So diversify yourself. Don't be just stuck in one place, because if something happens and you don't have any other alternative, you aren't going to be happy with the situation, right? So having that alternative is key, especially with bonds. And if you're trying like, oh, I'll just diversify in a bond fund, well, the return might not be there. But on top of that, there's just even less companies that are issuing bonds. So the diversification is just not there. Number 5, this was really cool. The self-directed IRA allows you to invest in these alternatives. You can invest, depending on your custodian, in a self-directed IRA with Worthy, or other things like wine and art and real estate. We could do a whole episode on using an IRA to invest in real estate. I personally don't recommend it because the rules are just insane. But if that's something that interests you, you can look into that. Number 6, never put all your eggs in one basket. I love how the director of Worthy said, don't invest all your money with us. What's wrong with you, right? Like this is a great, that just shows that she's being honest, right? She's not trying to say, yeah, give us all your money. It's going to be great. No. Never put all your eggs in one basket. It's one investment option among many. Number 7, you can use Worthy as a high yield savings account for like an emergency fund, because unlike other private bonds, it doesn't have the illiquidity risk. That money can come out immediately as you need it. Once again, we have that risk of what if the company just disappeared tomorrow, which can always happen. It could happen with a lot of things, but I just love using this as that spot where you park that money, get a 7% return on investment as you just have it going, and then you can just pull that money out as you need it for emergencies. Fantastic option there. Number 8, you don't have to sacrifice return for impact. This, I think, is basically the reason why I invited Worthy on, is that they're trying to use the money that I'm investing with them to make a difference, to make good things happen, to build communities. They're doing building projects, or to build senior living care. Those things are helpful and impactful for the community. And then number 9, I love this. Learn as much as you can. Always be learning more. That being an empowered learner yourself, being a lifelong learner is so important, whether it's in finances or anything. And as you do that, just remember that you are already rich. Your wallet just needs to catch up. If you would like help on your personal financial situation, go to teachermoneyshow.com/coaching, and you'll be able to find different ways that I can help you there. If you would like to participate in spreading this message of financial empowerment to teachers, I would encourage you to talk to your administrator or to your district level about going to SeanKMorgan.com to find more information there. And regardless of which one of those you need, please like and subscribe so that way we can spread the reach of this more. Leave a 5-star rating and review. That's going to help more teachers find this, and then turn around and tell a teacher friend. I really appreciate it.